So welcome to chapter 11. We are almost done with this semester. Just hang in there a little bit longer. We only have another 2 chapters to go to, this chapter and just one more, so we're almost done. So now we're going to go back to something that we've looked at earlier in this course. We've already looked at a worksheet, but now we're going to look at the worksheet under a perpetual inventory system. So a company that sells inventory and uses a perpetual inventory system. So remember, beginning inventory is the cost of the goods that we have on hand at the beginning of the period. So whether that's January 1 or, whether we use September 1 as our year and whatever our first day of our period is, whatever the cost of inventory, whatever's in our inventory T account, that's our beginning inventory. So as we purchase inventory, we'll debit the merchandise inventory account as we saw in chapter 10. And then when we sell inventory, we already know that we will credit the merchandise inventory account also. So then that should keep us under a perpetual inventory system, should keep us a running balance in what's in inventory. Now, if we do have a purchase discount, then we credit the merchandise inventory account for that. And if we return inventory that we had purchased, we would credit inventory. And if customers return inventory to us that they had purchased, so we have a sales return, then we would debit inventory, assuming that that inventory can be resold. Now, a perpetual inventory system makes sure that we update our inventory automatically every single time we make a sale. We keep a running update of our inventory system. Now, we do still need to count our inventory at the end of every period or during every period so that we can verify that our inventory records are correct. If we find that there's a mistake or there's a difference, then we'll need to adjust our inventory account. Now, mistakes happen. Something got sold and just didn't get rung up. Somebody miscoded something and so it got credited to the wrong account. It could have been shrinkage. Shrinkage could be anything from loss to theft, or it could be just that it was damaged. And remember, inventory is goods we have available for sale. So if it's damaged and we can't sell it, then we'll have to adjust for that as well. So here we have Arts Wholesale Company had inventory shrinkage of $500, and we need to record the journal entry to reflect that adjustment. So assuming that merchandise had an inventory of 19,000, we would want to credit inventory and we'll debit the cost of goods sold account for the amount of inventory that we are reducing it by. So remember, inventory is a asset with a normal debit balance. So when we credit inventory, we are reducing it, we're decreasing it, and we're increasing cost of goods sold, which is an expense account. And remember, expense accounts are always, always, always debited. Now, it is possible that we do our physical inventory account and we have more items on hand than our records show. Again, something may have gotten miscoded. We may have accidentally rung up 2 items for sale when really we only sold 1. Things like that happen. So here we're told that we have $19,000 balance in our inventory account, but a physical inventory account revealed that we had $19,500 of inventory on our shelves. So in this case, we would want to do the opposite of that previous entry. We're wanting to debit inventory and credit cost of goods sold now. Now remember, unearned revenue is when a customer pays for either a good or a service before they've actually received it. They pay for it in advance. And so when we take the customer's money, we now have a liability because we owe them that good or service. Unearned rent is another example. Let's say that we are renting some space and we collect rent from our renter before the rent is actually due or before the month has been used up, then we'll have unearned rent. Again, also a liability. So here we're told that we are subletting a portion of our space to another company for $200 a month. They go ahead and pay us $600 in advance. We take their $600, but now we have a liability because we now owe them 3 months of rent. We have to let them use this building for 3 months. So when we take their money, we're going to debit cash and we'll credit unearned rent, which is a liability account. Remember, liabilities have a normal credit balance. Now, once we have earned their money, once the period has passed and so we have earned it, we'll do an adjusting entry to debit unearned rent to reduce the liability and credit rental income or rent revenue, either one of those, but they're both revenue accounts and they have normal credit balances.